Welcome to digital learning platform of Shri Guru Sudhindra College. Course Bcom 4th semester. Subject Fundamentals of Financial Management. I have already explained the first method for calculating the working capital. Today we will discuss the second method for calculating the working capital, that is estimating current assets and current liabilities method. It is the oldest and traditional method of estimating the working capital requirements. According to this method, working capital is the excess of current assets over the current liabilities. Means working capital equals to current assets minus current liabilities. While calculating working capital, we should follow the following format. The format starts with current assets such as opening inventories, debtors, prepaid expenses, cash balance, etc. Then we deduct current liabilities from the total current assets. Current liabilities such as creditors, advance received, wages paid, manufacturing expenses, etc. Then we get working capital. We must add some percentage of contingencies to the working capital to get required working capital. If there is no any information related to contingencies, 10% margin contingencies will be taken. Let us discuss the illustration. The illustration contains the following information such as amount blocked up for stock such as stock of finished product, stock of raw material, average credit given inland sales, export sales, lag in payment of wages, stock of material, rent, royalties, etc., clerical staff, manager salary, miscellaneous expenses, etc. Now we'll discuss the solution. As I already said, the format begins with current assets. Here, the first one, opening inventories. Inventories are nothing but raw material, work in progress, finished goods, etc. The illustration shows raw material rupees 10,000, finished goods rupees 7,000. There is no any information related to work in progress, so the total opening inventory 17,000. Second one, debtors, in that inland sales for 6 weeks credit. Total amount of inland sales are rupees 2,08,000. Here we take only for 6 weeks. Therefore, inland sales amount should be 2,08,000 into 6 divided by 52 weeks, because per year equals to 52 weeks. To convert it into 6 weeks, we must consider 6 divided by 52 weeks. So the amount should be 24,000. Debtors also contain export sales rupees 78,000 per year. Illustration shows 1.5 week credit. So the amount should be 78,000 into 1.5 divided by 52 equals to 2,250. Therefore, the total debtor amount should be 26,250 rupees. Third one, payment in advance rupees 8,000 per year. Illustration shows sundry expenses paid quarterly in advance. So the amount should be 8,000 into 1 divided by 4, rupees 2,000. Because 1 year equals to 4 quarters. Advance amount paid is for 1 quarter. So to convert it into 1 quarter, we consider 1 divided by 4 or 3 divided by 12 months. Here 1 quarter equals to 3 months. Both are same. There is no any information related to cash balance. Then we get total current assets rupees 45,250. Then we must deduct current liabilities. In that first one, wages. Illustration shows that rupees 2,60,000 per year. But we must consider only for 2 weeks. So the amount should be 2,60,000 into 2 divided by 52 weeks, that is rupees 10,000. Second one, stock of material rupees 48,000 per year. Illustration shows it only for 1.5 month. So the amount should be 48,000 into 1.5 divided by 12 months is equal to rupees 6,000. Third one, rent and royalties rupees 10,000 per year. But as per illustration, it only for 6 months. So the amount should be 10,000 into 6 divided by 12 months, rupees 5,000. Clerical staff, rupees 62,400 per year. But illustration shows it only for half month. So the amount should be 62,400 into 0.5 divided by 12 months, 2,600. Fifth one, manager salary rupees 4,800 per year. Illustration shows it only for half month. So the amount should be 4,800 into 0.5 divided by 12 months, rupees 200. Sixth one, miscellaneous expenses rupees 48,000 per year, but the illustration it only for 1.5 month. So the amount should be 48,000 into 1.5 divided by 12 months, rupees 6,000. Then we get total current liability. We must deduct total current liability from the total current assets. By that we get net working capital. To calculate required working capital, we must add some percentage of contingencies to the net working capital. Illustration shows 10% contingency. So the amount should be 15,450 into 10%, 1,545. Then the required working capital should be 16,995. Undrawn profit have been excluded means while calculating we should not consider the undrawn profit because profit may or may not be used as working capital, and even if it is to be used for working capital, it should be reduced by income tax, dividend, etc. Thank you.